On behalf of Generational Capital, we welcome you to another part of our key series. Today, we have with us Satwik Jain, Fund Manager of RH Perennial PMA Scheme. The scheme has recently completed its maiden year, and we will be discussing the scheme's quarterly and annual performance today. Satwik comes with an extensive global investing experience, having identified several perennials through his mechanism of searching for capital efficient and wealth creation trends. We will also be discussing the current trend in the Indian markets, which is being affected by bouts of FII selling, global volatility, high oil prices coupled with inflationary pressures, and a tinge of a COVID wave rebound. So, Satwik, when Perennial started last year, you had an exuberant equity market, a freshly unlocked economy which was clearly in full swing. Whereas in the last 2 quarters, we have seen a lot of cooling down in the stock markets. How has your 1 year experience been like? Could you shed light on the performance of investing in the perennials?
Right. I thank you everyone for attending this webinar on a weekend. So I just prepared a brief presentation. So before that, the standard disclaimer is that the data is neither approved or disapproved by SEBI, and we will be taking a lot of stock names which are there in our portfolio. So it is by no means any recommendation. Now coming to basically what when I started, I was trying to do, and we would constantly be trying to achieve is a compounding between 18 to 25%. So that is essentially because the companies we are investing in, they are essentially doubling their earnings in 3 to 4 years, and are either market leaders or are on par to attain market leadership. So now you must be thinking that 18 to 24% is not that exciting. But if you invest 1 crore at 18%, your 1 crore becomes around 5.23 crores in 10 years, and in 20 years it becomes 27 crores. So, and if we are able to compound at 24%, we would probably be one of the best in the industry then. So 1 crore would become around 8.59 crores over 10 years, and over 20 years it would become 73 crores. Now coming to the performance. So the last quarter, especially from January to March, had been very tough. In fact, over the past more or less decade when I've been investing, it was probably one of the toughest quarters if we talk about return wise compared to the benchmark. So this is probably one of the few times where I have seen very high quality, high growth stocks having these toughest times in a decade, including GST demonetization, ILFS, Trump came, COVID came. So essentially, if we look at the global data also, the MSCI World Index was down around 9%, and the MSCI Value Index was up around 0.1% in January to March 22. So, this very seldom happens. And the thing is that, we can't be changing our investment strategy on the basis of this. Because, and in India also, if you see, over the last 3-4 months, basically foreign investors have sold around 2 lakh crores, which has been absorbed by the domestic investors. The SIP book has grown to more than 12,000 crores now. So, but the most of the domestic money we were seeing is going to a lot of small and mid caps names in sectors which we mostly tend to avoid. As a result of this, so I have showcased you quarterly data since now we have completed 1 year. So last quarter we had a significant drawdown compared to the benchmark. We were down around 7.6%. And if you see the previous quarters, so we were consistently beating the benchmark, generating decent alpha. So now I'm very much confident that over the next year also, because the quarter is a very small time frame to measure performance. So I think the companies which we are investing in, as you can see from the graph which I have tried to show below, their earnings growth should be approximately 20 odd percent at a portfolio level, and there is a significant for valuation re-rating also. So, and this call I would not end before answering each and every you handhold your hand, and any query you have, you can just message to Vinayak or the operations team. Now coming to the fundamentals of the portfolio. So basically what is have tried to do is we are essentially investing in, take you through each of them and their fundamental growth trajectory. So more or less the average growth in EBITDA and and this operating cash flow should be around 20 to 23, 24%, which is the average as well as the median. Now coming to the consumer basket. So firstly, if you look at the building materials basket, because we are very, very bullish on the building materials play in the consumer segment, because through the building materials play, we can play the real estate upcycle, which will happen without taking the balance sheet risk of the NBFCs as well as the real estate developers. So in the building materials, if we come to the paint companies, Asian Paints and Sirca Paints we are holding. So last quarter, Asian Paint did a 37% volume growth. Sirca Paint did 35% volume growth, but it is at one-third valuations of Asian Paints. Both are having similar ROCEs. So we expect, both of them to compound and basically double their cash flows anywhere between 3 to 4 years. In the wires and cable segment, we are holding Polycab and KI Industry. Polycab we had discussed at length in the last call also. So I'll spend some time on KI Industries now. KI Industries is the number 2 player in the wires and cable segment. It has been one of the largest wealth creators over the past 7-8 years. I think it has been a 100 bagger now, but it is still available at 20 times price to earnings. And there are a lot of changes happening in the business. So earlier the company was mostly focused on the EPC business, which had to do business with the government, but now they're focusing on the retail business. So from 30 odd percent, their retail business has grown to around 45-50%, and they have established a lot of distribution also. Moreover, there are plans of also going into the FMEG segment, like what a Polycab had done. So what I foresee, and it is available at a 18 to 20 times price to earnings multiple, and it can easily. And one more important thing is, right now it is at around 5,000 odd crores of revenue. It is doing an 800 crores of capex. So if they kind of execute the capex, they normally do an 8x asset turnover. So as it is in 3 years, the revenues only should double. Along with that, the working capital cycle should become tighter, because now they are stopping the EPC business. The return on capital employed should also improve. So from say an 18-20 time multiple, it should go to a Polycab kind of a multiple, which is like a 35 times. So here we see the potential both for earnings as well as valuation re-rating. Apart from that, in the building material segment, we are also holding Astral. So Astral is one of our largest bets in the portfolio. Also, it is probably the largest holding now. So Astral, Mr. Engineer, made a monopoly in the pipe segment. Right now, they have around a 50 odd percent market share. But what now they are doing is they are just not stopping at that. Out of the cash flows from the pipe segment, they made a whole new business in the adhesives market. So their adhesives business is now a 1,000 crore plus business. I think they are the only serious competitor to Pidilite to have emerged over the last 3-4 years. And now an interesting thing which they are doing is they have got into the water tank segment also. After Syntex became bankrupt, a huge 5,000 crore opportunity was left open, and they're trying to grasp that. So I think Astral can keep on compounding its cash flows at pretty decent rates over the foreseeable future, and should be one of the decent compounders here. Coming to other portfolio companies in the consumer basket, so Hindustan Foods is also an interesting company which we added in the last quarter. So in Hindustan Food, what we were seeing was after 2014, when the company went into a hyper-scaling mode, their sales CAGR has been more than 100%, because they got funded by Six Sense Ventures, and after that they got contracts from marquee players like say Unilever, Reckitt Benckiser, a lot of these new D2C brands, and they're putting up factories after factories because of that. As a result, their EBITDA has compounded at more than 100%. From the current run rate which they are doing, they can easily double their revenues in the next 2 years only. And the valuations also look pretty reasonable. So we thought that, it could be one of our good emerging monopoly plays. Other portfolio companies are Relaxo Footwear, Whirlpool, India. So Relaxo Footwear. So we expect it not to do, very spectacular things. We have cut some position there because we thought that, at around 70 time price to multiple, growing at 15 to 18%, it would not make a lot of IRR to us. So we have reduced our position in Relaxo Footwear, but it is still a part of our portfolio. Whirlpool had a pretty bad year last year, but it is still doing around 100% return on invested capital, and it is just completed its Faridabad manufacturing facility. So, and with the onset of the summers, we expect that at least its historical growth rate of around an 18% revenue growth should come back. If it doesn't, then we'll take a call as to what to do. Now coming to the technology basket. So we are normally very, very bullish on the technology play, but these are normally not the loss making kind of companies. So I'll give you a broad picture. The overall, Nifty profits were around 6.6 lakh crores, which I've showcased you in the graph over the last year. Out of that, only IT services did around 91,000 plus crores of profits, which was the highest. IT services itself are doing around 13 crore of the whole corporate profits. You can say that out of that, TCS, Infosys, and HCL Tech do around 60 to 70,000 crore, and then LTI, Coforge, and a couple of others make up the remaining part of it. So what my thesis is that over the next decade, when India and this profit pools move from 6.6 lakh crore to around 20 lakh crore, which is like a 3.5x over the next 10 years or 12% kind of a compounding, this profit should at least move to 30%, right? Because that is what has been happening globally, and they're all the marks of it. Like very few other sectors at this scale have these kind of cash flows as well as revenue growth, right? So that is the broad thesis. Now, in the whole scenario, we have taken positions in two IT services companies, which are LNT Infotech as well as Coforge. LNT Infotech is in the largest cap IT companies, is the fastest growing company. It reported its quarterly results 2 days back only. It did around a 27% revenue growth. There was a bit of margin pressure, but that is more or less normal. In fact, its attrition rates were even better than what TCS and Infosys have reported. Coforge is the fastest growing IT company across India. Last quarter, it grew at 50%. If we remove the acquisition also, it will continuously grow at 35 odd percent. And it has moved from the government heavy business to more secular businesses like insurance, healthcare, banking, among others. So, and it is still available at a 25 to 30 time price to earnings. Apart from that, we are also holding Info Edge. You cannot call it IT, but it is more or less a technology company. It is probably the only listed platform company which is profitable at this scale, apart from Nykaa, of course. It is having 100% return on invested capital on its core Naukri business. They are growing at more than 20 odd percent, and they are probably the best venture capitalist in India, having a 39% IRR over the last 17 years, having many winners like Zomato, Policy Bazaar, and now I'm seeing a lot of decent companies like Happily Unmarried, Khata Book, among others. Now coming to Saregama, so I also consider it an technology company only, mainly because the whole business model only has shifted. So if you see, till a couple of years back, there was no music licensing industry. We all used to go to songs.pk or any other website and just download pirated music normally. When this music licensing industry came, this industry itself has grown at a 37% CAGR over the last 5 years, and globally it is a very consolidated industry, with UMG, Sony, and Warner accounting for 70% of all streams. In India also, it is a very, very nascent industry. Totally, the revenues of the industries are around 1400 crore, with the top 6 labels like Yashraj Music, Z, Sony, Tips, Saregama accounting for 80% of the industry. Now, an interesting thing has happened in Saregama. They are demerging their core licensing business and their other businesses like the magazine business, Karava, among others. So, when the demerger happens, we will be having a pure play licensing industry, where the valuations also we expect would be much, much higher. And coming finally to the healthcare sector. Healthcare, we are in fact seeing a lot of companies which are potential hyperscalers. So, like Privesh Denpro and Tarsan Products came up with their IPO recently only, I think over the last 6 months. And they are doing a lot of mega capex. So Privesh Denpro is like scaling up its capacity by 3x from 8 crore to 24 crore. Tarsan is doing from 100 to 500 crore all over the next 3-4 years. So the revenues can easily go up many fold, and the doubling of earnings in 3 to 4 years should be much faster also. And these companies are available at pretty reasonable valuations also. So Privesh, I think, is at around 25 time price to earning. Tarsans with these high quality numbers also is available at a 30 odd time price to earning. Among the other players, Dr. Lal Path Labs, so we had cut some position in the previous quarter only because the valuations did not make sense. Now at around 2500, it is beginning to make sense, but we'll see depending on the other opportunities. JB Chemical and Pharmaceutical has become very aggressive related to the acquisitions and the ANDA filing. So recently it acquired a company which was growing at 35% CAGR, having around 100 crore of sales. It is now also contemplating an acquisition of a 75 crore revenue company. So more or less, from the old management, when the new promoter took over, the company has become very aggressive with very high, good quality unit economics. So as I said, why we are very bullish on the healthcare sector. If you see globally also, healthcare in the S&P 500 as well as the MSCI World ETF has around a 13% exposure. In India only, it is around 5 to 6%. And normally we have seen trends are global. So this 5 to 6% should go to, at least double digits over the next decade. In financials, we are only holding 2 companies, which are Bajaj Finance. So Bajaj Finance reported its quarterly update. It grew at more than 26%. I think it is one of our core holdings and will be a core holding if the management keeps on compounding, anywhere above 20%. Valuation derating, I do not think should happen because of the scarcity premium it will get. It has now crossed 5.7 crore customers and AUM has crossed 2 lakh crores. Kotak Mahindra Bank is probably the best capital allocator in the country. He was conservative all these years when all these tier 2 banks like RBL, IDFC were growing at a very fast pace when the chips were down. Now he's showing a lot of aggression and buying out Volkswagen Finance. But with Kotak also we'll keep on evaluating, whether the earnings can be have the potential to double in 3 to 4 years. If that does not happen, and we find any better opportunity, then we'll take a call. So that was more or less about the portfolio. Now, so there are 3 parts to the overall macro story. The corporate leverage is at an all-time low. If you see the last 20 years of data, right, it is at, I think, 0.7 right now, and it is at an all-time low right from 2001. A strong capex cycle seems to be unfolding. That has led to the growth of some of our portfolio companies also, like a Polycab and KEI Industries. And the individual balance sheet, especially the top 10% of the economy, who are mostly in the technology as well as financial sector, they have benefited from the last 2 years. Their spending has gone through the roof, and you can see that that the Mercedes and the all the luxury car sales are hitting all-time highs. If you go to any hotel now, especially in the tourist areas, the room rates are going through the roof. So on and so forth. And finally, the government balance sheet was looked with a lot of skepticism. Last month, I think it crossed a 1.2 lakh crore run rate. The forex reserves are very, very strong. So I think, these are the best time for organized players to create wealth. But at our perennial fund, we are mostly bottom-up stock pickers. And we look at companies which can double their earnings in 3 to 4 years, irrespective of the macro conditions. And finally, the way forward and my closing remarks. So the basics of wealth creation would not change on a year-on-year basis. Normally, judging by a quarter's performance, and that also, when the growth index has not outperformed, that was down more or less 7-8%. I believe would not be, a rational thing, simply because it has to do a lot of with a very random observation, because now providing ex post explanation for the price movement implies that we knew from before what would happen, but that is simply not the case. We were and we would be focused on emerging as well as established monopolies in the 5 sectors of our liking, with consolidating profit pools, companies which have clean promoters and who are willing to share profits with the minority shareholders. Along with that, very strong competitive advantages like network effects, low cost of production, strong brands. More or less, in our portfolio, we feel that the established monopoly portfolio is decent, but we would be keen on identifying a lot of these new emerging hyperscalers. So a lot of these new IPOs which have come, or our research is taking a lot of time. So some companies which we are interested in are like Hariom Pipes, Vedant Fashions, but the valuations there, that those we'll have to see. And finally, so basically India will add around 4 to 5 trillion GDP over the next 7-8 years, and the profit pools will go from 6.5 lakh to even 20 lakh. We are very bullish on our sectors which have created wealth, will create wealth going ahead also. So I think, Vinayak, that was more or less from my side. Now we can take up the questions.
Right. Thank you so much, Satwik, for sharing your views on each of these holdings. I mean, usually PMS managers don't go into such detail justifying their holdings. So that's really positive for each of our investors. So investors, now we are open to getting questions from your end, and I already have got a few questions, Satwik. So the first question that we've got is, it is obviously you said you're not tracking macros too much. But there is definitely the fact that inflation is something that has come in, especially in the emerging economies as well as in developed economies. US is seeing inflation levels not even seen in India. So, do you feel that this inflation pressure is going to impact the bottom lines of stocks in their Q4 or next 1 or 2 earnings? We've already seen in Infosys and HDFC that there has been some correction post the Q4 earnings. So, do you see any of that in happening in the perennial portfolio?
Right. So, especially if you talk about the consumer basket, so we were doing some channel checks with our companies also. So, and we saw the past record also. So, for example, in the Q2, when crude had risen by what it had risen, so Asian Paints had increased its prices by around 13.16%. So, more or less, we have seen that, when the whole industry is affected, normally the players pass on the prices. For another example, so I went to the local wire dealer recently, only in the last week. So the 1,000 rupee wire which was sold by a polycab is now being sold for around 2,200, because copper wires have more or less doubled. So, but my broad understanding is that, for a couple of quarters, there would be some pain, post that the entrepreneur would pass it on, right? And then things would be more or less normal. That is what my understanding is. Yeah, but if you take, companies like the steel companies or these basically metal companies, when the price rises, they have to pass that on, and when it falls, they have to pass that on also, right? So, but in these kind of companies like the paint, wires, and cable company, when the price falls, I'm sure they would not, decrease the rate by that magnitude, as has been seen by the past track record. So more or less that margin improvement should be there when the mean reversion happens.
Right, right. So we've not seen, FMCG stocks figuring in, something like a Dabur or a Hindu Lever or maybe Britannia in your portfolio. What is your view on such stocks?
So, we were holding Nestle till 2 quarters back, and then we had sold it. So that was the only FMCG stock we were holding. So more or less the reason is that, it did not fit our framework. So we are looking for doubling of earnings in max like 4 years. So no FMCG company, qualified that criteria. And more or less everyone is growing at 10-12%, except you can say a Dabur, which is growing at 15-16% and are available at, say, anywhere between 60 to 100 times price to earning. So I, frankly do not see how we would make a decent IRR there. It is good for the preservation of capital, but for making decent IRRs, I'm not sure how that would happen. So otherwise, the other consumer companies, especially in the building material space, we are holding a lot of them.
Right, right. And also getting a lot of questions on the tech stocks that you hold. There is one question regarding the performance that LTI is doing okay, but Coforge's performance has not been great, especially when it comes to the stock prices. So what is your view on that?
Right, right. So we have been holding Coforge since around 6 months. It is more or less, I think around 5% down only. So I think more or less the reason behind this is, then we saw it in other companies also, equity back, like say an SBI card. So when a lot of then basically buying does not happen at that scale. So Coforge promoter borrowing. So they recently, I think, offloaded around 20 odd percent stake. They issued ADRs also in the USA. So but that kind of float comes in the market, where would the buyers come from? But like my opinion is, like, there is nothing wrong with the business, and like if you are patient, it can be one of the largest winners going ahead if the company executes on the way doing that. Grow by 40-50% in a cycle like now, and then
Right, right. So another question that we are getting in is on the fact that Perennial has invested in the Nasdaq N100 ETF. Recently, we saw Netflix was in the news due to a huge correction on account of the falling subscriber base, and there were further reports of a muted performance in the next few quarters. So the rise in stock was in sync when the pandemic was at its peak, and the fall has come as the COVID wave has abated. So if you analyze the stock performance, it was not supported by a rise in positive operating cash flows. How important do you feel are cash flows in a particular stock, and how do you figure that out in your perennial fund?
Right. So if suppose I am also running my own business, or if I'm investing in any business, ultimately whatever value I'll give to that business today, it is discounted value of the future cash flows. Now the thing is that in an FMCG company, we can see the terminal value from now only, that these companies are growing at 8-10% from now only, and will keep on growing that. In say an Astral Pipe or a Polycab, we can say, okay, they are growing at 20 odd percent now, but they will grow at 10% later when they become a bit more mature. But in these basically mostly platform kind of companies, like you can say a Policy Bazaar or a Paytm, there is no visibility of free cash flow now. But okay, we say that if the management executes, it might come say 10-15 years down the line. Now the whole skill lies that, if we are able to see that properly and, manage that properly. But like, I am very, very skeptical on these new age kind of companies right now, and that has been seen in the stock price performance also, given the, the euphoria with which they came. Regarding the Nasdaq exposure, so, that was mostly because that we were positive on these FANG stocks mostly, which are your Facebook, Amazon, Netflix, Google, and Alpha. So yeah, so more or less these five companies. Out of the three are doing okay, and Netflix and Facebook, which have now become Meta, are not doing that great. But like, that is okay. Even if we have like a 60-70% success rate, I think at an overall portfolio level, we should be doing okay.
Right, right. And also, you're getting one view on, there are so many opportunities in the unlisted space. So, listed space is something that we've really talked about, and obviously, people have their own views that maybe right now valuations are not justified. Some people are saying that there is going to be maybe, sorry, growth is in question, or maybe, stocks may not perform as given how inflation is there, and there's going to be a liquidity tightening. There might be some pain in the stock market for the next 6-8 months. So how do you see opportunities in the unlisted space, especially that I believe you also invested in some companies, startups that you identified in your personal portfolio. So would you like to share some thoughts on that with our investors?
Right. So, if you talk about the fund, I think have invested in the best private equity player in the our fund, which is InfoEdge. Basically, I think no one has come close to generating the IRR they have done on their startup portfolio. And, here you don't have to pay any management fees, no carry and all. So I think in the public market space, that is like a no-brainer. According to me, it has been one of my like oldest holdings since I started. And now also it is one of the top five. That is a separate thing that it did not perform in the last year, but that is okay. That is a part. Sometimes you perform in a year, sometimes you do not. And regarding the startup space, so so we normally do not actively recommend startups, but since I am personally investing my like family money through Venture Catalyst, so till now we have invested in around five companies. So, we now what we have done is we have partnered with them, that whoever the clients are at Generational Capital, the family offices, if they want to only invest, then we kind of co-invest with them. So wherever I am investing, some of our clients co-invest, and then we, take some stakes in companies. Notable ones being like Melora, which is now the largest jewelry retailer, Resha Mandi, which is now the monopoly in the silk value chain, so on and so forth.
That is definitely good for our investors, because a lot of them are looking to diversify their investments, especially because maybe although they have a long-term view, in the short term, the public market may be subject to some fluctuations. So I believe at Generational Capital, we can definitely identify such opportunities along with a fund manager like Satwik, who can help us, and obviously backed by a research team. So definitely that helps us in giving and presenting such opportunities to our investors regarding this. Also, what are your views on SMEs these days? Again, the conversation comes back to maybe, let's say, growth, whether that will be impacted by inflation, price margins. So, what are your views on SME stocks? Maybe like a pre-vest that you have.
Right. So, in SME, what the underlying, if it's a company, then SME, small cap, large cap, or even an Amazon, which is like as large as the Indian economy, the everything remains same. The business is about inflows and outflows, or for that matter, even a startup. Sorry. But basically, the SMEs, we have to be very, very careful that the disclosures are not that high, right? And the companies are traded in lots, and the liquidity is not there. But what we at Perennial Fund also have done is, suppose Privest we bought, one lot is of around 8 lakhs, and we have to take like a 3 odd percent position. So we kind of, segregate, we buy one lot and kind of segregate it in various client portfolios. For example, in 3 client portfolios of around 50 lakh. But the due diligence has to be, a lot higher in the SMEs compared to, say, a Bajaj Finance and all. And we prefer SMEs, which are doing quarterly con call, doing earning releases. So there is a simple check. For example, they are mandated that every 6 months they have to publish their results. But which SMEs are doing it 3 months and also doing investor calls? So those I'm more interested in. So like Sirka Paints also now it is a small cap company, but say 3 years back it was an SME company only. It was also traded in lot. So we saw that journey also now. So more or less it remains same, but just the due diligence has to be same. And in the PMS format, this additional benefit is there that basically we can segregate the lots to different client portfolios.
Right. And also we spoke of FMCG stocks. Adani Wilmar got recently listed and the stock performance has obviously been stellar. So I know you must be getting a lot, but no Adani stocks in your portfolio.
So in fact, my first company when I used to started investing was Adani Transmission. So we bought it at 20 rupees, sold it at 100 rupees. Now it has crossed, I think, 3,000 rupees. But broadly, what I've seen is I could not make sense of its numbers, what they were doing, and even the holding structure. So around 1 to 2% only is with the public. Rest 98% we could not, do a lot of due diligence on who the holders were except the promoters. So that's why we left it. And moreover, the forensics, did not make a lot of sense, and we try to avoid these leveraged companies. But if you look at what they are doing, they kind of build the monopolies in any sector which they are getting into. So if you see Mumbai, the whole ports are owned by them, the whole distribution is owned by them, and going by how they are scaling, FMCG also they will scale up a lot. Half of the transmission in India is being owned by them through Adani Transmission and all. And now they're going to the green side of energy. So basically, they hyper scale very, very fast. So as of now, we do not have any. Now let's see what the future holds.
Right. And position sizing. How do you look at taking positions in stocks? What is the brainchild behind it?
Right. So normally we follow this 2-4-6 kind of a framework, where if any new emerging company is coming which is having say low liquidity, showing promise but not a lot of track record, so we normally tend to allocate around 2 to 3% to it. Say companies like Privesh Denpro, Tarson's Products, Sirka Paints, these kind of companies where we know that okay, there might be a risk to capital. 4% is companies which have proven themselves, but probably the growth might not be that strong, like a Relaxo Footwear or an Abbott India or a JB Chemical. Right. In the 6% basket, here we see, say, companies which are growing at a decent pace also and have established a long track records and are either monopolies or near monopolies in their own sectors. So these will be companies like Astral Pipes, Titan Company, LNT Infotech, so on and so forth, Bajaj Finance. So that is the broad framework which we apply. And then, if a company is scaling up due to the increase in share price, then we normally tend to not cut it because we try to ride our winners. That is how large wealth is created.
Right. Speaking of LNT Infotech again, there was news. There has been buzz regarding a potential merger with Mindtree. So, any impact on your holdings, or what is your positive? What is your view on the stock in the longer term?
So see, what I tend to look at, I told you, like, the nominal GDP is growing at 11-12%. If I can find a company which is growing anywhere above 18% with a strong promoter, good quality promoter, as well as, very high capital efficiency. LNT Infotech is doing around, I think, 30 odd percent return on capital employed, and its reinvestment rate is 50%. So, even if it grows at 18 to 20% over the long term, with the Mindtree acquisition also, by the way, Mindtree also is growing at around 20 odd percent only. So I think it should be a good play. And with Mindtree, what would happen is LNT Infotech is strong in the banking and financial domain. Mindtree will be more strong in the communications, media, TMT domain, and it might lead to some cost synergies. But then that merger ratios, the valuations that have to be seen. But more or less, it would not make a lot of impact on the long-term story.
Right. So you foresee it being value accretive only to the stock. Obviously, subject
right.
to the.
That depends on, that depends on how the merger is.
Right. And also, we're getting a question on the telecom sector. Now that it seems like the worst is over for this sector, and definitely as part of the India growth story, telecom is going to be now we're seeing it shift towards a few top 2 or 3 companies that are going to be there. So what are your views on those stocks? Definitely one of the two of the largest players, they're going to show good numbers possibly. So any chance of getting those?
Yeah, so it might be a 3-player or a 2-player market, but more or less it will be a 3-player market only. But if you see the journey from 2000, right, when India shifted from the landline phone to directly this mobile telephone, there has been immense volume growth. If you see the telecom volume growth, I think it has been around a 20 odd percent CAGR over the last 20 years. But no players have made a lot of money. Now, Geo is another thing. I'll come to that later. But if you see other players, they used to be around 14, 15 players, right? All of them have been washed away simply because, the only one guy set the price and other guys have to match that. So as such, there is very less pricing power. And now, so that we had seen in the past couple of years, now they have started increasing prices once Jio has also realized that, now the market share is more or less there and now we need to monetize it. But, it's a very, very competitive industry, capital intensive also. So, and there are a lot of other good opportunities. So why to, stress so much on this? No, but if you talk about, Reliance also, say when Reliance Retail is listed, so then I would be very, very interested, if the valuations are decent. Because in retail, what happens is you have a very, very long runway for growth. And, if you see globally also, Walmart and Costco, they right now also growing at only 5-6%, but they still get valuations double of an Amazon or an Alphabet, who are growing at 3-4 times of what a Walmart or a Costco is doing, because the markets know that these are secular stories and very simple to understand. That you get the unit economics right, you put up new stores and you keep on growing, so on and so forth. So in the Geo part, I would be more interested in, but otherwise telecoms, I think I would avoid as a whole.
Right. And there is a question on Affle. So any views on the Affle stock?
Apple basically, we were tracking when its IPO came, it was showing pretty good numbers. But, somehow I was not comfortable with the accounting, or I could not understand the accounting. Maybe that's why we left. I think it's a regret only the stock has become 4x. But when we do not understand the accounting, we simply, kind of give it a pass, because errors of omission are better than errors of commission, basically.
Right. And speaking of global investments, we've seen global markets cool down a lot as compared to the Indian market. So do you find attractive opportunities in the global space? And if anyone is looking to invest directly in US equities, or let's say any other international market, or let's say China, for example, so what would you recommend to our investors?
So currently what is happening is, so most of the COVID induced rally, now the companies have gone back to those levels. So if you see all the decent companies there globally also, right? So they have also corrected pretty decently. So I would say, if I was a global asset allocator, the US markets are more attractive than the Indian markets right now, because there the earnings also are coming of obviously the companies which were producing earnings. And I'm talking about companies like, say, Starbucks, Lonza, Thermo Fisher, Apple, Alphabet, so on and so forth. Though they have also corrected a good 20-25% from the peak. That has not been the case in India, and they are available at 15-18 times price to earning. If I was a global allocator, in short, I would be more bullish on the US markets now. Now, coming to the investment route, so one thing is that, now the mutual funds have been banned. So normally at Generational Capital, we used to recommend mutual funds. So now basically not banned, but the inflows have been stopped for some time. So, but some LRS routes are there, so I think those can be explored by investors who are very, very keen. But for mutual funds, we'll have to see, when RBI increases the limits and then start inflows there.
Right. And also, there's a question regarding one of your portfolio stocks, Hindustan Fund's a recent addition. So, do you see it as a hyperscaler? Some light on its growth story as well.
Right. So Hindustan Foods, from around 50 odd crore revenue, it scaled up to 2,000 crores, all in around 6-7 years, right? The sales CAGR was around 144%. And it is a simple, very simple business model. You do a contract with, so there are three business models there. One, you do a contract with a large MNC like a Reckitt Benckiser. Okay, I'll manufacture your mortine. You give 70% of the capital to set up factory. Rest 30 I will put as the mixture of equity and debt. And whatever the whatever happens now to the production, I'll get a fixed 18 to 20% IRR. So this is the most simple business model. Then they also do a profit sharing with smaller players, these emerging D2C brands. So now what is happening as the trend played out in pharma, that companies are thinking that okay, I do not want to get into the hassle of manufacturing my own product, scaling up or downsizing the capacity. I want to take control of the branding, distribution, and the marketing, where the real money lies and where the real growth will happen. And this can be outsourced to a credible party which has a decent track record, and I know that he would supply the products of decent quality. So I think Hindustan Food is right now the number one contract manufacturer in India. No one is even close. In fact, the second competitor I think is only 10% of its size. And currently also they are setting up a plant in Uttar Pradesh, around 125 crore capex they are doing. So my calculations are, and the management has also more or less guided, that over the next 2 years only this 2000 crore would become 4000 crore of revenue. Even that 2 takes 3 years, I think decent compounding should happen here. And it would probably be one of the fastest growing portfolio companies, if not the fastest.
Right. So thank you for answering that. So just to summarize this all, so how do you feel regarding the India growth story? We have a stable political environment. The companies are growing. Obviously, there is an inflation pressure that we have to deal with, and in the last MPC meeting, RBI took note of that, and maybe we can see a few rate hikes happening whenever that comes in. So how would you position your portfolio, and how would you advise investors to position their portfolios?
Well, so broadly, if you talk about the last decade, right, it was the lowest compounding for Nifty since we started in around 1980. Previously, it used to be around 16 to 17%. Last decade, the Nifty compounding was only 11%, I think, right? So, but now, at with the start of 2021, or we see all the right signs which were there in say 2001 to that the capex cycle is unfolding. Especially the RBI is very, very accommodative. The kind of steps they are taking, those are very, very good for the financial as well as the debt market. Apart from that, the consumption seems to be very, very strong with the discretionary income growing. So from around $2,000 per capita, which earlier used to be around say 100, 200. Now we should cross around $4,000 per capita. NSE 500 profit should go to around 20 lakh crores over the next 10 years. So I think in the light of these, I think the four sectors where they are focusing on, and that is more or less an outcome of our finding companies which are in the hyper-scaling mode with the safety of capital and very strong competitive advantage, which are consumer, pharma, technology, and healthcare. I think these should broadly do well over the next decade. The horses would keep on changing. For example, we might sell a DMart and get into an Hindustan Foods or a Kia Industries. But I think broadly this should be the theme going ahead.
Right. So there you have it. Satwik, thank you so much for joining us, shedding light on the perennial portfolio. We hope we were able to answer a lot of questions regarding the future prospects of how the market is looking like, and also the performance of each of these stocks that Satwik has so kindly told us about. So if any of you are investors or any one of you is looking for further guidance regarding their investments, portfolios, or asset allocation across markets like debt, equity, startups, unlisted space, then you can feel free to contact us at Generational Capital. The contact is given in the link, and it's also available on YouTube. And you can always open our website at generationalcapital.in and reach out to us. So a very good afternoon to all of you. Thank you so much for taking time out. Thank you, Satwik, for joining us, and we look forward to having more key series sessions with you.
Thank you, everyone.